Hi, this is David Skrika. I'm the editor of AddictedToProfits.net and the author of The Great Supercycle, and I have the special presentation for you here today on inflation and the decline of the U.S. dollar. I'm opening up the website to a special offer that I only do one time a year, and we'll tell you about more of that in our next video that will be released on Monday when the offer opens. But I thought I'd take the time here today to tell you why, and this is not just a shameless offer and the whatnot, but why this is actually a very important turning point for your portfolio and a turning point in economic and geopolitical history, in that we're seeing the implosion or the decline of the reserve currency of the world. Now, this happens on average about once every century. In the 18th century, it happened to the Spanish. In the 19th century, it happened to the French. In the 20th century, it happened to the British, where a major superpower implodes and their currency declines. And this is one of the theses of my book, The Great Supercycle, written in 2009, published in 2010, which has predicted a lot of the things that have happened in just the past 6 months, such as increased inflation, increased commodity prices, decline of the U.S. dollar, increased prices in gold and precious metals, and in energy. And now in this presentation, we're going to show you how to protect yourself from this decline, because this decline in the currency can seriously affect the value of your portfolio, your assets, and your standard of living. And most Americans are not protecting themselves against this coming inflation tidal wave. The death of the dollar. Right now, the dollar is in a long-term decline, and you must protect yourself. All superpowers in history have imploded. The UK, the Spanish, the French, the Romans, they all did the same thing the U.S. is doing now. They overexpanded their empires, they borrowed too much money, they printed too much money, that leads to a devaluation of a currency, massive inflation, and an implosion of the empire. So basically, this is happening now in the U.S., and that means that U.S. financial assets will continue to outperform more real assets, such as gold and silver commodities, and some foreign equities. These continue to outperform. And what really the thing about inflation, what it does, it hides the fact that, because you don't feel poorer because you think your stocks are still going up or whatever, but because of the devaluation in the currency and the rise of inflation, you're actually not making money, and your stocks are not going up as fast as you think. And let me give you a quick example of this. This is the S&P in terms of the euro. And as we can see from it has been actually going down this year, despite the fact the S&P has been in a bull market. And we can see that the S&P at the bottom, which started the year at roughly 1260, has gone up to 1360, up nearly 8%. And actually, in terms of the euro, the S&P is down over 2% this year. So again, because they're devaluing the currency and printing money and creating inflation, asset prices are going up. But in terms of from a European standpoint and a global standpoint, because the euro has gone up like every other currency against the U.S. dollar, U.S. assets are actually going down in price. And this also hurts your standard of living. What happens if you want to do a vacation in Europe? You could have said, oh, I made 8% of my portfolio. I'll sell some stocks and pay for my vacation. But actually, you'll find that your increase in portfolio didn't even keep up with the value of the European currency. So this is the S&P and the euro in the last 10 years. Shows us from a bigger picture. In the last 10 years, the S&P is down 7%. Now, reinvested dividends will actually be up in that time frame, but roughly flat, down 7% in the last 10 years. In European terms, you're down 37%. So even with reinvested dividends, you are down in the S&P in euro terms. And of course, this scares away foreign investment, because foreigners are actually losing money because of the change in the currency. And again, it hurts your standard of living because your stock portfolio is not keeping up with the value of global asset markets. So this just shows you why you must diversify out of the dollar, because even though it may not seem like your equities are going down, they're actually going down a lot faster than you think. S&P divided by gold is even worse. Now again, the S&P is down about 7% in the last 10, 11 years. In terms of gold, the S&P is down 82%. So if you had just invested in a few ounces of gold, you would have more than outperformed the S&P by about fourfold, and you would have kept up with that increase of the euro against gold. So on a global scale, you would have diversified out of the dollar into gold, and you would have kept your purchasing power and your standard of living. This is another example of it. Another thing we do is you adjust stock prices for inflation. But the problem with that is, while stocks have devalued because of inflation, the CPI that they use today in the United States, according to John Williams, who runs shadowstats.com, actually understates inflation. They changed the philosophy in in the late 80s, early 90s, and as you can see, ever since then, the blue is how they used to report inflation, the red is how they do it today. That inflation is actually much higher than reported. Before the financial crisis, we were actually up into the double-digit inflation, much like we saw back in the 70s, and we can see actually we're back there again right now, which makes sense because with oil at 140 and agricultural commodities up 40-50% in the last year. We're all feeling the inflation pinch, despite the fact what the government is telling us. So again, we must diversify out of dollar assets so we can protect ourselves against this inflation. And the U.S. is giving us no return on our fixed income right now. So again, we must find other means of investing to do so. So we can see this is the U.S. dollar index against a basket of 6 currencies, and we can see we have been in a long-term decline here the last 10 years, and importantly, we kind of have been in this trading range since the 2008 financial crisis. We have broken down the key support area of about 74, 75 in the U.S. dollar index. Now, we will find some short-term support here and may have a short-term bounce, but it's very important that when that short-term bounce happens, you get out of your dollar assets, because we're probably going to break this 2008 low sometime within the next few years. And again, your assets in U.S. dollars will continue to devalue and decrease your standard of living. And in my newsletter, Addicted to Profits, we show you investment themes and how you can do that. And another classic example is how the devaluation of the dollar it hurts you is Microsoft in the last 11 years, and not had a good 11 years, is actually up 12%. But again, to a European investor, Microsoft is down 30%. So again, that scares away foreign investment, because when a European investor has to sell his or her Microsoft and put it back into euros, they're going to see that price go down. So this is David Skrika. That we just wanted to show you the effect that the devaluation of the dollar happens on a global scale, how it is decreasing your standard of living. Like trips to Europe. It's not because Europe is expensive like people are saying now. It's because the dollar is going down and making Europe seem expensive, it decreases the value of your portfolio. Then inflation's eating into it because they're printing money, and then they're underreporting inflation. So we must protect ourselves against this inflation tidal wave, because the printing of money, the deficits are not stopping anytime soon. And I'll just give you a quick example of the type of things we're going to talk about in the video Monday, like other themes. For example, this is the Bombay Stock Exchange. As we can see, compared to the S&P, is up 354% in the last 11 years, or 10 years. Now, the rupee has been about equal to the dollar the last 10 years, up a tiny bit, but nothing to say. But when you divide the Bombay Stock Exchange by the euro, up 182%, even in euro terms. So protecting yourself against currency devaluation. Emerging markets growing a lot faster, one way to do it. Another way is to invest in commodities. We can see this is the CCI, which is a basket of commodities, from base metals to precious metals to energy, etc. We can see, again, the CCI is up 205% in the past 10 years. In euro terms, the CCI is up 90%. So again, the CCI protected yourself, invested in commodities, protected yourself, unlike equities, against the devaluation of the dollar, is even up even in euro terms. So again, these trends I think are still intact, and we're going to show you which ones will continue to outperform in our upcoming presentation on Monday. So again, this is David Skrika, Addicted to Profits, signing off, and I hope you've enjoyed this video, and we hope that you end up becoming a subscriber sooner rather than later.